What if Trump wanted China to dig in? I mean, what if the plan all along was to trap President Xi at the worst possible moment? Right now, China's economy, they're struggling. Youth unemployment is spiking, foreign investments are drying up, and consumer confidence, it's tanking. And in the middle of all that, Trump hits them with tariffs as high as 145%. That's not random. That's a strategy. And here's the trap. President Xi, he's got two choices, and really both of them are bad. If he stays defiant, their economy keeps tanking. I mean, these tariffs are already doing damage. But if he picks up the phone and tries to make a deal with Trump, well, then he looks weak. And in communist China, that's more than just embarrassing. I mean, that's dangerous. The whole system runs on projecting strength and control. And if Xi looks like he's bowing to the United States pressure, well, it chips away at his grip on power. And here's the kicker, though. China, they built their entire economy on exports. And about a quarter of those exports go straight to the United States. So really, without us, they're in big trouble. I mean, we're already finding other suppliers. And they just can't pivot that quickly. So either way, Trump wins. Xi, he takes the hit. And now people are saying Trump's isolating America from the rest of the world. Is he? Or is something bigger going on? Follow for part 2. It's in my profile.
The theoretical purpose of the tariffs is to bring more manufacturing back to the United States. So as an owner of a manufacturing facility in the US, let me tell you how it's affected our business. We are a small cosmetics lab and manufacturing facility in Indiana. There's a lot of conflicting effects going on, so let's talk about it. For the first week, I would say some customers freaked out and either decided to place their order with us right away before prices were affected, and some were like, never mind, I need to pause. It's all about risk tolerance. As the tariffs on China have gotten higher and higher, a lot of our clients with open manufacturing orders have said, I need to pause, I can't ship my packaging out of China just yet. So we're seeing some delays, right? And because of that, then we also need to delay a little bit on our hiring timeline for our team. We were planning on hiring this many people, and now we had to cut it down just a little bit to account for the gap in the schedule or the delays that might be coming down the road. Additionally, we're not sure how prices are going to change for ingredients. So although some of our ingredient suppliers have reached out with pricing changes, many of them haven't. We have begun updating our models with all of the new prices and will continuously update them. Additionally, any quotes that we issue now are only valid for 2 weeks because we don't know what's going to happen more than 2 weeks out. To be clear though, we don't even know what's going to happen 2 weeks out. We're still guessing a little bit. Finally, this was the intention of the tariffs. It hasn't come to fruition yet, but I'll tell you very early what we're seeing. Just this week alone, I probably signed 30 NDAs with new potential clients. Normally in an average week, I'm signing anywhere from like 5 to 10 NDAs, so it's quite a few. What that means is those NDAs are from prospective clients who want to move their manufacturing from another lab to ours or from another country to ours. They say, hey, let's get an NDA in place and we can share our formulas, then we can get quotes. They're all still in the exploratory phase, but I would say if the tariffs hold on for another 4 to 6 weeks, we're probably going to have a lot of new clients, and then we would have to hire a lot of new people. But you do have to wonder what that's going to mean in terms of inflation and prices across the board, because I'm sure the prices that they'll pay with us here, manufacturing in the US, will be much, much, much higher than manufacturing abroad. So can you say the tariffs are working? I don't know. I'm just giving you the data points. You can figure out what you want from that. It is a little bit funny seeing some of the intended and unintended effects play out in real time.
China, are you going to play hardball with them? Are you going to mention COVID?
Well, I'm not going to say, no, I'm not going to mention COVID. I'm not going to say, oh, I'm going to play hardball with China. I'm going to play hardball with you, President Xi. No. We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal because otherwise they're not going to be able to deal in the United States. So we want them involved, but they have to, and other countries have to make a deal. And if they don't make a deal, we'll set the deal because we're the ones that set the deal. Scott and Howard and myself and others, we're going to be setting the deal, and it'll be a fair deal for everybody, and it'll be, I think it's a process that's going to go pretty quickly. 145% is very high, and it won't be that high. It's not going to be that high. It got up to there. We were talking about fentanyl, where, various elements built it up to 145. No, it won't be anywhere near that high.
And what level do you think it'll come down to if you
It'll come down substantially, but it won't be zero. It used to be zero. We were just destroyed. China was taking us for a ride, and just not going to happen. It's not going to happen. We're going to be very good to China. I have a great relationship with President Xi, but they would make billions and billions and billions of dollars a year, and they would build their military out of the United States and what they made, so that won't happen. But they're going to do very well, and I think they're going to be happy, and I think we're going to live together very happily and ideally work together. So I think it's going to work out very well. But no, it's at 145%. There will not be anywhere near that number.
President Trump's trade wars are likely to slow down economic growth across the globe significantly this year. That is the projection from the International Monetary Fund today, estimating the U.S. economy will slow down by an entire percentage point compared to last year, growing by just 1.8%. Global growth was projected to slow by half of a percentage point.
Tariffs and uncertainty are rattling other important parts of the economy. The dollar has continued its slide, and investors are showing that they have new worries about Treasury bonds, often some of the safest investments. But the U.S. markets rebounded substantially today. That came after Treasury Secretary Scott Bessent reportedly told investors that he believes the trade war with China is unsustainable and hopes tariffs on both sides could be eased. The Dow gained back more than 1,000 points, or 2.6%. The Nasdaq jumped 2.7%, and the S&P 500 also gained about 2.5%. And late today, President Trump suggested he was open to easing up on the trade wars with China.
I'm not going to say, oh, I'm going to play hardball with China. I'm going to play hardball with you, President Xi. No. We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal, because otherwise they're not going to be able to deal in the United States.
To help us understand the volatility in the markets, let's turn now to longtime financial journalist and CNBC contributor Ron Insana. Ron, it's great to be able to draw on your insights on a day like today. Thanks for being here.
I was hoping to get some insights from you, Jeff.
We'll see about that, friend.
As much volatility as I've seen in my lifetime.
Well, let's talk about that, because the Treasury Secretary reportedly saying he expects a de-escalation in the president's trade war with China. You heard the president there himself. What's your read on all that's happening, and what is this potentially setting the stage for?
Well, they're most clearly and most definitively listening to the financial markets, as you both outlined at the top of the show. I mean, not only is global growth being downgraded, U.S. growth is being downgraded. The IMF actually behind private economists in doing that. And then you've seen these, ripples in the Treasury market, the decline in the dollar to a 3-year low, the turmoil in the stock market. And financial instruments are telling politicians, number one, moving this fast without a plan is a very bad idea. Some of the ideas themselves are bad, like potentially firing Fed Chairman Jay Powell, and also just engaging in an all-out trade war is detrimental to growth, if not devastating, should it become a full-blown international event. And so I think they're starting to get the message, and particularly the Treasury Secretary is probably trying to talk the president off the ledge, as it were, with respect to some of the more harsh comments he's made about Jay Powell recently, and also about this intensifying trade war with China, which the Treasury Secretary effectively called an embargo. That's a big word to use in an environment like this.
Well, you mentioned the markets, and let's talk more about that, because before today's rally, the Wall Street Journal noted that the Dow Jones Industrial Average was headed for the worst April since the Great Depression, since 1932, because of a lack of confidence by investors. I mean, is this period of volatility, is this our new normal, at least for as long as this tariff plan, this trade war lasts?
Yeah, I absolutely think volatility is going to remain elevated. I mean, maybe not to the extent that we saw in the last several weeks, but I do think that until we get clarity around where these negotiations are going and what the actual end game is, what we want from each and every one of our trading partners is clear, and whether or not there are agreements to be had. Remember, these often take months or years to construct, and they're trying to do multiple deals, as many as 70 deals within 90 days. That's something that I would assume is impossible. Progress on this front would be helpful to financial markets, to be sure, but the issues around that, whether or not we have a fully set of sustainable deals that are long-term in nature is really what the market needs to calm down and start following more traditional metrics like corporate earnings, the direction of interest rates, should lower rates be warranted, things like that that are germane to typical market behavior.
Well, the president, at least for today, is easing up on China. He's also easing up, apparently, on the Fed chair, Jay Powell. Today, he told reporters, he said, I have no intention of firing him. Last week, he said, quote, if I want him out, he'll be out of there real fast, believe me. The president is still voicing his desire for the Fed to cut rates. Is the Fed strong enough to resist the pressure? Because not every institution, not every American institution, as we've seen, has been strong enough to resist the pressure from the Trump administration.
Yeah, I think the Fed most definitely is. I think Jay Powell has even said, both privately and maybe even publicly, that he would spend every last nickel that he has fighting to stay in his job. And the Fed as an institution has been extremely independent as an agency for quite some time. And again, I think that the independence of the Fed is critical to the safety and soundness of U.S. assets, the way foreigners view the stability of the U.S. economy, the reliability of the dollar or U.S. Treasury bonds. All of those things are really important. Now, the Fed may still hear from President Trump, on an ongoing basis about lowering rates, but the Fed will do what it does when it needs to do it. So I think this is going to be no longer a test of wills. I think Jay Powell now, given that the president just said that today, that he has no intention of firing Jay Powell, which my colleague Eamon Javers at CNBC asked him about. I think we're okay until his term expires. Who he ultimately replaces him with is an open question. But I think the Fed, now that the president has backed off, will be able to withstand these pressures.
And lastly, Ron, when the IMF, the International Monetary Fund, slashes its U.S. and global economic forecasts, it says the U.S. economy is expected to grow by about 1.8%. That's down from its January estimate of 2.7%. Put that in plain English. What does that mean for the economy and the prospects potentially of a recession?
Well, the IMF appears to be slightly more optimistic than most private economists. We've heard estimates that there's as much of as a 90% chance of a recession if these tariffs remained in place for a sustained period. And so personally, I think 1.8% is a little bit optimistic if the tariff negotiations go on for several more months. We're already hearing that, shipments of goods from China have all but ceased, and that ports in Los Angeles and Long Beach, California, have quieted down considerably and not receiving a lot of goods. And so these are long cycle types of phenomena that if indeed this were to persist for some time, getting 1.8% growth would be a victory, given that we grew about 2.5% last year. My guess is that we're going to grow under 1% this year if this type of uncertainty persists, both in terms of market behavior and ultimately in terms of businesses' inability to plan around the tariffs, whatever they might be. This is, as I said earlier, this is going to take time to work out. So the first 2 or 3 quarters of this year might be a little bit weaker than even the IMF is suggesting.
That is Ron Insana. Ron, always a pleasure. Thanks for being with us.
Thanks for having me.
Good news if you were worried about the U.S. Postal Service deciding to stop accepting packages from China and Hong Kong. A short time ago, that decision was reversed. The original announcement, which was yesterday, followed President Trump's executive order that imposed an additional 10% tariff on goods from China and ended an exemption that allowed companies to avoid paying tariffs for low-cost shipments. The Trump administration is, big picture, pushing China to do more to stop chemicals for dangerous drugs like fentanyl from being shipped into North America.
I have a source who was in the room who's given me a written rough transcript of exactly what Besson said at that conference yesterday. I want to bring it to you because obviously it's moving the market today. According to this source in the room, what the Treasury Secretary said was no one thinks the current status quo is sustainable at 145 and 125% in terms of the relationship with tariffs with China. He says, so I would posit that over the very near future there will be de-escalation. And I think that should give the world, the markets, a sigh of relief. He also goes on to say, I do say China is going to be a slog in terms of the negotiations because that engagement started. I would not yet. But I think, again, I think neither side thinks the status quo is sustainable, but I've said quite a bit. So what Besson is saying here is that neither the United States nor the Chinese side thinks that the trade relationship is sustainable between the two countries. And he also says here that he views this ultimately as an embargo between the two countries, that it's ultimately going to have to lead to some kind of negotiation. And he talks about the idea of rebalancing the two nations' trade relationship together. He says they have stifled the consumer economy and favored manufacturing. We want to increase manufacturing. The identity of that would be less consumption. And if somehow I could see a Ray Dalio essay on this, like a big, beautiful rebalancing. If we walk out the door of negotiations and sign something in 2 or 3 years that looked like that, I would think that it's a huge win. And then the trade practices, the goal of that is not that hard a break. We want to stay engaged, but it's going to be more fair. So that's a summary, again, from a person who was in the room of exactly what the Treasury Secretary told that audience at the J.P. Morgan event yesterday, guys.
Did you know Chinese TikTokers are calling out American tariffs and going viral for it? They're claiming they can sell you Lululemon level leggings for less than $5.
I don't care about the name. If the product is doing what it's supposed to do at the end of the day, I'm fine with it.
Personally, I wouldn't mind getting a bag that maybe it doesn't have the logo, but it's good quality. It'll last me a longer time.
Whatever is cheapest, I'm gonna go for that.
Straight from the same factories, no middleman, no markup. Sounds like a deal, right? But here's the twist. Brands like Lululemon are warning those $5 duplicates are counterfeit. So is this a money-saving hack or a fashion scam?
So I think there is definitely some factories that are selling this product with a different name, or it is maybe just like a factory that's like, oh, okay, we're making it, but then in reality, nothing's going on.
I'm not entirely sure. I don't want to say it's a scam, but also at the same time, I don't think it's like completely trustworthy.
This has all happened because of U.S. tariffs imposed under Trump. And now Chinese factories are clapping back hard on TikTok, mocking the tariffs, selling direct, and pushing anti-American sentiment. But the loophole that lets you skip those import taxes, it's closing May 2nd. That means even your cheap TikTok haul might not stay cheap for long. So you have a designer bag.
Yeah.
What do you have?
I have a Goyard bag that I bought like 2 years ago.
How much was it?
I think about maybe $1,500.
We live in times, is all I gotta say.
So what do you think? Is this China outsmarting U.S. policy, or are we getting played by fake labels and flashy videos?
The U.S.-China trade war has kicked off. Just look at these containers piling up on the docks. These are all waiting to be exported. This footage was taken on April 11th by a Douyin user in Zhejiang at a local port. It's not just Zhejiang. In recent days, major export hubs along China's coast, including Guangdong, Shanghai, and even Hong Kong, have seen freight operations come to a near standstill. Ports in these areas are now filled with containers waiting to be shipped. The 145% tariff imposed by the United States on Chinese goods has officially taken effect, triggering severe disruption across China's export supply chain. According to Chinese financial outlet Caixin, at Shanghai's Yangshan and Waigaoqiao ports, many shipments bound for the U.S. were rushed onto vessels in a race to depart before the tariffs were enforced. But after the U.S. announced a 125% tariff, Shanghai's once busy export activity came to a sudden stop within days. By April 10th, almost no cargo ships bound for the U.S. could be seen. Reports say many cargo ships and freight flights between China and the U.S. have been canceled. Containers that missed the shipping deadline are now stuck at dockside storage yards, and many exporters are filing customs return paperwork. It is estimated that about half the shipping capacity on U.S.-China routes will be canceled in the near future. According to Radio Free Asia, Mr. Qian, an exporter from Guangdong, currently on a business trip in Shanghai, said in an April 11th interview that Yantian Port in Guangdong is seeing the same situation as Shanghai. Containers are stacked high, and very few cargo ships are leaving.
Let's talk facts, not fear. China will lose this trade war, and I'm going to show you why. There's a lot of news out there that somehow keeps saying that the United States is fighting a losing battle, but they don't go into numbers and facts like we do on this page. So let's get into the numbers and show why they're just trying to get your clicks. The first thing to note is that the investment into China hit a 30-year low 2 years ago, and it's dropped as much as 90%. And that only increases the foreign investment gap between the United States and China. But just how much are we talking? Well, the United States has foreign investment of $5.39 trillion, while China is coming in at $13.4 billion. That's a direct reflection of the confidence other countries have in the United States and China to get a return on that investment. On top of that, the International Monetary Fund came out and talked about what the economic outlook will look like during this trade war. And it shows that China is now expected to expand 4% this year and next. That's down roughly half a point from its previous forecasts, meaning that the IMF, who's in charge of the monetary policy and overseeing the economies of the entire globe, is now saying that China's economy is set to slow down by a half a percentage point. So that doesn't really instill a whole lot of confidence in Chinese growth. And one of the main talking points is how China is one of the biggest exporters in the world, and they pretty much fuel the entire global economy. But the issue with that argument is that in September 2024, China reported a dramatic 15% year-over-year decline in their export volumes, dropping the sharpest in a decade. And that was before Trump got into office. Now that Trump's in office, what do you think that that's doing to their exports now? So if we're talking who's going to win the trade war, I think we can all agree that it's going to be the United States, and I give China about a month to 2 months before they completely fold.
War, China has essentially used its full propaganda force to tell the Chinese people it's okay. Now, many Chinese store owners have even enacted the so-called 104% service fee, matching that of the previous tariffs. One Billiard owner says here on the screen that they're charging Americans 104% service fee as the U.S. embassy, but then when he was asked, do you even have any U.S. customers, he says no. That's the hypocrisy here, and the issue is the blind nationalism. The CCP isn't really telling them the reality, which is that America doesn't need China, but China definitely needs America when it comes to exports of manufacturing. So what if people starve in China? Mao did it, so the CCP doesn't care. Now, in this interview, some stock factories have lost profit up to 10 times compared to previous years, and it costs more to run the machines. Affected by tariffs, this owner of a down-Celts factory says 90% of their exports go to the U.S., but he says our small business may be the fastest victims in this trade war, but he will still fight the U.S., even if it means he has to pawn his pants to do so. So yeah, you see this riling up the nationalism does work when it comes to people who have no access to information outside of China.
The U.S. 350 million people controls a third of the world's consumer market. You know what that means? Out of every $3 spent worldwide, one comes from an American wallet. The EU has 450 million people, but their spending power doesn't even come close to the US. We've got 1.4 billion people working our butts off making stuff, but our buying power is only a fifth of America's. The numbers are right there.
Once the tariffs went up, the factory turned into a retirement home. This time last year, the machines were deafening. Now, not even rats come around. 2 million yuan worth of goods are stacked up like mountains, and no one wants them, not even for free. The workers sit outside in the sun all day, and I'm paying their basic wages out of my own pocket. The bank is hounding me every day over the loan. If this keeps up for another 3 months, these machines will be worth nothing but scrap. The Americans raised tariffs without a second thought, but it's killing those of us in real industry. Does anyone have a way to clear out this inventory? I'll take scrap prices if I have to. A clothing factory owner is clearing out inventory due to excess stock.
Does anyone want these white pants? If you don't mind, you can just take them. It's such a shame to throw away tens of thousands of them. The US is hitting us with heavy tariffs, and these goods are affected. Physical stores are closing down. All the big brands are shipping their genuine products with labels. There's only 3 days left, so I'm clearing everything out at a discount. If you've never bought before, now's the time to try a few.
The US-China trade war has dealt a devastating blow to industries that depend on exports to the United States, especially in sectors such as textiles, apparel, electronics, and automotive products. Factories that previously manufactured goods for American brands have been hit hardest, with widespread order cancellations and even finished products left without buyers. Many factories have been forced to halt production or attempt to reduce inventory through domestic sales, but weak consumer demand at home has limited the impact, resulting in heavy losses. Today is April 10th. U.S. tariffs have surged to a staggering 145%. Many friends running OEM factories for American brands told me all their U.S. orders were canceled. Even completed goods are being rejected, and shipments that already reached the port are being pulled back. Some shameless clients are even demanding their deposits back. When disaster hits, it's always the factories left holding the...
Donald Trump just got the EU to offer to drop tariffs on all American products. Like literally 3 days of threatening the EU with tariffs. And Europe is now ready to drop all tariffs on U.S. products. Oh, and Vietnam's doing the same thing. They want to drop all tariffs on U.S. products. Oh, and so does India. You know, no more tariffs on the products we want to sell to the big people that live in that country. Oh yeah, and Israel getting rid of tariffs on U.S. products. And Japan. And South Korea. And Thailand. Oh, and 43 other nations. All offering Donald Trump 0% tariffs on U.S. products. He did all that in 5 days. 195 sovereign nations in the world, and more than a quarter of them are now offering 0 tariffs on U.S. products just so they can continue to trade with us. And all because Donald Trump was willing to threaten them with.
What's the hardest part of doing injection molding? It's when we get all these brand new molds in, but the orders are gone. Once the 145% tariff hit, our orders basically disappeared. This batch of goods still had some hope when the tariff was at 54%. The customer said we could keep going, but when it suddenly jumped to 104%, they told us to stop everything. The new molds had just arrived, were loaded onto the machines, and within a day they were taken off. This round of tariffs has had a huge impact. The day it rose to 104% was terrifying. Our entire industrial zone here usually stays lit until 9 PM. But that night, by 6 PM, all the lights were off. Everyone had gone home. We normally run more than 30 machines, but now we can only keep half of them running. The rest have all been shut down. It's been really tough.
This TikToker is the owner of an injection molding factory in Ningbo, Zhejiang province. What he said reflects the painful reality many Chinese manufacturers are now facing. Ever since the U.S. raised tariffs to 145%, all of his orders from American customers have been canceled. Many other TikTokers are posting similar videos, saying that because of the tariffs, U.S. orders disappeared overnight. Now the people with no work and no income are China's frontline factory workers. One TikToker working at a shoe factory in Jiangsu said a small factory producing shoes has shut down because of the U.S.-China tariff war. The video shows empty workshops, piles of unsold goods, and once busy assembly lines that have now fallen silent. On April 11th, China announced it would impose a 125% tariff on U.S. goods in retaliation for the U.S.'s 145% tariff. The Chinese authorities stated clearly that this is the highest rate they will go, and that U.S. products no longer have any market in China. If the U.S. raises tariffs further, China says it will not follow. This marks the end of the first phase of the tariff war that began on April 2nd under President Trump.
China is panicking over tariffs moving heaven and earth and hundreds of billions of dollars to hide its worst economic crisis since COVID. Is China on the edge of collapse, or will they come to the table? After Trump imposed 145% tariffs on most Chinese goods, last week Beijing commanded its 867,000 state-owned enterprises, which make up a third of China's economy and most of its stock market, to buy their own shares to desperately prop up Chinese stock markets. It told private brokerages to monitor customers for, quote, excessive selling, presumably tied to your social credit score, since China is a police state. Meanwhile, commanded Chinese banks to buy yuan and dump dollars to prevent the Chinese currency from collapsing. The People's Bank of China, their Federal Reserve, jumped in, selling billions of U.S. treasuries not to crash our bond market, but to save the yuan. Beijing then cranked up the printing presses, promising the biggest fiscal deficit since 2010, the 2008 crisis aftermath, including dumping $178 billion of so-called special treasury bonds aimed at infrastructure, so bridges to nowhere to soak up unemployed workers, along with direct payments to companies hit by tariffs. I mentioned in recent videos how last tariff war in 2018, China paid for the tariffs so its companies could maintain market share, which made the 2018 tariffs on China pretty much a free lunch. Note, all of this is on top of a $1.4 trillion stimulus package that China rolled out just after Trump's election. So the background here is China was not doing so hot before Trump's tariffs. Trillions in cheap money drove overproduction. At one point, China had 400 electric vehicle makers, of which 300 have already failed. About 100 to go. Copy and paste across hundreds of industries, and China has to dump cheap goods overseas. Overcapacity put China into deflation, but China's export prices crashed by 20% in some goods. This was already causing tensions with Europe, who opened anti-dumping probes on China before Trump showed up. Toss in the collapse in Chinese property markets, also bloated by cheap money, and a crash in foreign investment. It was negative $168 billion in 2024, and more than half of the Chinese economy was already in recession before Trump. So what's next? Brought to you by Unchained.com. There's an entire industry of pundits predicting that China's on the verge of collapse, that it is a giant house of cards. In the long run, I don't think that's true. In many ways, China is much stronger than the U.S., certainly in manufacturing, which we stupidly gave away. The Chinese education system and small business environment offer valuable lessons for our useless politicians and bureaucrats. Having said at the moment, China is a lot more vulnerable than it looks. China's companies are swimming in debt. Their banks are over-leveraged, gambling big with a small pot, and exports to the U.S. make up a big enough share of China's economy to crash both. If that happens, Beijing may be forced to liquidate its overseas holdings, which are overwhelmingly parked in dollar assets, in order to fund the mother of bailouts. In a recent video, I mentioned how the dollar is falling and U.S. stocks are falling, partly because foreigners are liquidating. If China jumps in with both feet, we could see even bigger drops in the dollar and stock markets, extending to the bond markets that prop up our entire financial system. Okay, we'll be watching. See you next time.